Hello everyone, welcome back. Today we will discover chapter 12, the cost of capital. These are some of the basics. Cost of capital is the cost to a firm for capital funding. In other words, the return to the providers of those funds. So this word I think is really complex to understand, even for me. So why don't we take a look at this example? This is Elon Musk, the former richest billionaire in the world. One sunny day, he goes to Bank of America and he asks to borrow an amount of money at 3% interest rate. On another sunny day, for no specific reason, Minchuan University suddenly needs a lot of money and they cannot find anyone to let them borrow money except for Elon Musk. Elon Musk say, "Alright, I will let you borrow my money, but at the rate of 7%. So if we take 3% plus 7% and we divide it by 2, it's gonna be equal to 5%, right? Because 3 plus 7 is 10 and 10 divided by 2 is 5. So what can we say from this 5%? This is me, Andy, a guy standing outside the market, and I really want to invest in this company, which is Tesla. As I can see that the average cost of this company is 5% because they borrow at the rate of 3% and they lend other people at the rate of 7%, which give them the average cost of 5%. As an investor outside, I would say that, if I want to invest in a company, I must require some sort of return which is higher than 5% so that my money gonna come back, knowing that the risk is 3% because they always have to pay the interest. And guess what? This 5% is also called the WACC, the weighted average cost of capital. By definition, the required return on the firm's assets based on the market's perception of the risk of those assets. The weights are determined by how much of each type of financing is used. Well, so the example that I just show you guys actually is the way how I break complex ideas into simple terms. Because the actual components of the WACC is much more difficult. And so let's find it out together. So the first component of the weighted cost average of the capital is the cost of equity. And there are two ways for us to compute the cost of equity. We can either use the dividend growth model or we can use the SML. SML stands for Security Market Line. For the dividend growth model, as we all know that to compute the price of a stock, we can use this formula equal to dividend in year number 1 divided by the required return minus G. Here, the required return is actually the cost of equity, And so if we rewrite the formula, the cost of equity will be equal to D1 divided by P0 plus G, and so on. And the next model to compute the RE is the security market line. The formula is cost of equity equal to RF. RF stands for risk-free rate. What is risk-free rate? So risk-free rate is the rate of return for risk-free asset. What are risk-free assets? Example is treasury bond. So treasury bond is actually a type of money that the government, a type of bond that the government borrow from the citizen. And from the government perspective, you can always print money. You print money, whatever you want, how much you want to pay back the debt in any case. So because you are the government, you have the unlimited power to print money. So that is the reason why I say that the treasury bond is a risk-free asset. Next, BE is the company beta. So beta is actually We can also call it the risk level of the company. And in the exercise, mostly professor will provide us with the number, so we don't need to worry about it. All right. Next is ERM minus RF. ERM stands for expected market return. Expected market return of the company. And RF again is the risk-free rate. And combining them together by taking the expected market return minus RF, we have the market risk premium. This is an example. Let's try to compute the RE, the cost of equity, based on this number. So company has a beta of 1.5, the market risk premium 9%, current risk-free rate 6%, analysts estimate of growth 6% per year, last dividend 2, current stock price 15.65. So let's use both methods in order to compute the RE, the dividend growth model. So RE, as we all know, will be equal to D1 divided by P0 plus G. How can we compute D1? So we know that a company currently have the last dividend of $2. And last dividend, which means it's going to be D0. And our tax is to compute D1, right? To compute D1, we simply take 2, which is D0, times 1 plus the growth rate, which is 6% per year, so 0.6, divided by P0. P0, yes, is 15.65. Next, we plus with the growth rate, which is also 0.6%. Together, we have 19.55%. How about the security market line method? So RE will be equal to the risk-free rate. And as you can see, the current risk-free rate is 6%. So it's going to be 6% plus the beta. The beta of the company is 1.5. So 1.5 times the expected market return minus the RF, which we also call it the market risk premium. And this number is equal to 9%. So expected RM minus RF is equal to 9%. So we can actually write 9% straight off. And if we compute this one, we can also get 19.55%. This is how we compute the cost of capital based on the number provided in the example. The second component of the WACC is the cost of debt. The cost of debt is the required return on a company debt. To compute, we have two methods. Either we compute the yield to the maturity on existing debt, or we use the estimate of current rates based on the bond rating expected on new debt. Remember, the cost of debt is not the coupon rate. Here we have an example. We have a current bond which is issued with 15 years to maturity, coupon rate of 10%, coupon will be paid semi-annually, and currently bond price equal to $1,253.72. Our job is to compute what is the YTM of this bond. So here you guys can easily use the BA calculator, as I have shown you guys many times in previous video. So the result that I get from the calculator is equal to 8.9%. The yield to maturity of this bond is 8.9%. So so we just computed the YTM. Will this one be the cost of debt? Yes, it is the cost of debt. But what kind of debt? It's the cost of debt before tax. Before tax. What do I mean? So the debt is tax deductible. And the easy way to explain this Imagine from the company's perspective, you make a lot of money, a lot of revenue. But then you have to pay back your creditor the interest because you borrow money from them. So your profit will actually be lower. So you're gonna go to the government and you ask them, you tell them, hey, you know what? I make a lot of money, but at the same time, I have to pay my creditors back all the interest. So my profit is much more smaller. And the government gonna look at you and say, oh, wow, it actually makes sense. Okay, I'm a very good guy. I will give you a tax deductible because I know you don't have much profit so that you can still grow your business in the future, all right? So that's how it works. That's how it works. It is tax deductible. You receive a tax deduction. Therefore, the final cost of debt, the final formula for the cost of debt. Cost of debt before tax, BT, this one, YTM, times 1 minus corporate tax, which is the tax rate for your company. In this case, this exercise, as we have the YTM at 8.9%, we take 8.9% times 1 minus tax rate. So let me assume that the tax rate is equal to 40%. So 8.9 times 1, 8.9%, sorry, 1 minus 0.4, which is 40%. This will be equal to 5.34%. And this is an example of how can we compute the cost of debt on a company perspective. And the last component of WACC is the cost of preferred stock. So preferred stock is a type of stock which gives the owner the right to receive the same amount of money every single year. For example, you are an investor for a tea company. You have preferred stock. Every year, the company will guarantee you to pay you $5. This is the dividend from preferred stock. Take this dividend divided by the price of the share. We get the RP, which is the cost of preferred stock. So we have thus discovered all the components of WACC. This is the final formula in order to compute the WACC, the weighted average cost of capital. It's going to be equal to the percentage of common equity divided by the V, which is the company value, times the cost of equity, plus the percentage of preferred stock in the capital structure, times the RP, plus the percentage of debt in the capital structure, times the RD, times 1 minus the corporate tax. So let me break down this formula easily for you guys, all right? Because I believe that people may have some kind of confusion for things, for example, the E divided by V, P divided by V, or D divided by V, because I haven't told you guys about this one yet. Let me give you an easy example. If a company has a market value of $1 billion, $1 billion. In this $1 billion, they will have $500 million of equity, $200 million of debt, and also $300 million of preferred stock. So the E divided by V, which is the percentage of common equity, will be equal to 0.5 billion, which is $500 million, divided by 1 billion, which is equal to 50%, or 0.5. Similarly, the percentage of debt, D divided by V, will be equal to 200, which is 0.2, divided by 1, equal to 0.2. And P divided by V will be equal to 0.3 divided by 1, which is equal to 0.3. Do you guys get it? I believe you guys do.